An Irish woman had moved home to Ireland after many years in the US, and I had to advise her that her move could cost her $600,000. Why? Well, she'd spent several years working in the US for a multinational company. During that time, she built up an investment portfolio, including 2 million worth of US listed shares. As a US tax resident, she was protected from US estate tax by an exemption which was then $12 million, meaning her estate would not pay any US tax on her debt. But the moment she became tax resident in Ireland again, everything changes. Under current rules, a US citizen or resident is entitled to a generous federal estate tax exemption. However, a non-resident, non-citizen, such as an Irish person living in Ireland, only gets $60,000. If they die holding US located assets, their estate may be liable for up to 40% US tax. In this case, her 2 million shareholding would attract a potential US tax exposure of $600,000. This catches Irish nationals returning to Ireland with US stock options or US brokerage accounts. Worse still, the US tax liability is not creditable against Irish inheritance tax. In this case, my client's relocation was weeks away. No US tax advisor had raised this problem. No Irish accountant had flagged it either. This is another example of why you should always consult with a tax expert when making a large decision. You see, cross-border tax planning isn't something you want handled by someone who prepares company accounts and files routine tax returns. There are legitimate ways to restructure or mitigate liabilities to this type of tax, but it requires expert advice and usually action in advance. So if you're returning to Ireland and need tax advice, you can book a consultation with me via the link in my bio or online at taxunwrapped.ie.